Let's take a look at the final part of the flexible budget and variance analysis. We will now take a look at computing and analyzing variances. For us to understand how to compute and analyze, we need to know the variance significance. It's either termed as favorable variance or unfavorable variance if there are differences. But if there are no differences, then we call that as zero variance. Let's take a look at the first part, which is favorable variance. Let's say if you have the actual cost lesser than the amount that you have budgeted for, we call that as favorable variance. Very easy. Why is it favorable? Because you spend lesser than the amount that you have budgeted for. But it will turn to be an unfavorable variance when your actual cost is higher than your standard, meaning that you spend more in actual case compared to what you have budgeted for. So let's take a look at this example, how to do the calculation. The amount that you see or the unit of analysis in terms of the rates involved, 250 and then 3,500 plus 20Q. These are the matter of having the poster produced and sold in terms of the quantity. Planning, you have 150 that you plan to buy to sell, and then in actual you only manage to sell 100. So let's take a look at how they are calculated. So revenue, planning, you anticipate to have 37,500, but actual, the amount of quantity sold is only 100, and that doesn't mean that you need to sell at 250 because that is the amount of selling price that you have budgeted for before. Now, maybe you increase the sales price or whatever, and then your actual revenue will be 30,000. So if you compare between the planning budget 37,500 and the actual results of 30,000, you see a difference of 7,500. And you need to indicate whether it is a favorable difference or unfavorable difference. How to do that? You need to look at the planning budget and actual results, 37,500 and 30,000. So since we are talking about revenue here, your budgeted revenue is 37,500, but in actual you only managed to collect 30,000. We call that as unfavorable. But for the others, expenses, rental until miscellaneous expenses, you will need to see whether the actual is higher than the standard cost. If the actual cost are higher than the standard cost, you will see the unfavorable result next to you. So once you have calculated the revenue minus all the expenses, you will see how much is the net operating income for you. So if the total of unfavorable is higher than favorable, which you can see in our case, then you will have the final net operating income to be unfavorable as well. So this will be some formula that you'll need to apply when you calculate the variable overhead variance. So we'll have the standard variable overhead, in which you have the standard quantity multiplied by the standard rate, and then actual quantity at standard rate, and then we have actual variable overhead, in which you get it by taking the actual quantity multiplied by actual rate. And then you will see the variable overhead efficiency variance. So that's the formula that we will apply. You take SQ minus AQ and then you multiply by SR, then you'll get the variable overhead efficiency variance. And then variable overhead rate variance, you'll take SR minus AR and then multiply by AQ. So for you to be able to identify how much is the variable overhead variance, then you need to compare between SQ, SR, and then minus AQ, AR. So you need to multiply those rates and also quantity. So fixed overhead variance is computed like this. Let's say if you have fixed overhead in actual case 4,500, and then you have budgeted fixed overhead 4,900, you compare between them, you'll get the cost variance of 400 because the difference is 400 ringgit. But if you are comparing between budgeted fixed overhead and allocated fixed overhead, 4,900 and 5,200, there is a difference of 300. But you need to understand whether to put F or U, favorable or unfavorable. So in this case, if actual cost is lesser than your budgeted fixed overhead, in our case 400, we say that it is favorable. But because in the second part, which is volume variance, you have 4,900 and 5,200, the difference is 300 in terms of the fixed overhead allocated higher than the fixed budgeted overhead, then you have the favorable as well, because it is still favorable. But in total, you need to see the difference or just add them up if they have the same favorable or unfavorable. In our case, both are having this favorable. It should give you this 700 ringgit in total. So in summary, the flexible budget is regarded as the best estimate of what revenues and costs should have been given the actual level of activity during the period. The variance analysis is very important because it is made up of quantity variance and price variance, in which you can analyze whether the performance of the business is good or not. And a flexible budget performance report is a management report that compares the actual revenues and cost with the budgeted revenues and costs based on the actual sales volume. So I hope that you get some insights from this presentation. Thank you.